When allocating to any asset class, it's crucial to assess how it behaves alongside your traditional holdings. Given its high-risk profile, Bitcoin is not appropriate for all investors. That being said, crypto assets, including Bitcoin, can possibly enhance diversification, improve risk-adjusted returns, and introduce new sources of potential upside when managed thoughtfully and sized appropriately. It's crucial to assess your client's risk tolerance, investment goals, time horizon, overall financial situation, and their technical expertise if they are going to purchase Bitcoin directly. A conservative approach suggests limiting exposure to a minimal percentage, perhaps 1 to 5%, allocated exclusively from capital that investors can afford to lose. This allows for participation in potential upside while limiting the downside risks from volatility. From January 2017 to May 2024, the standard 60/40 portfolio achieved a 9.1% annualized return, but by incorporating a 4% quarterly rebalanced position in Bitcoin to the standard 60/40 portfolio, the annualized return jumped to 16.2% in that same time frame. This allocation should be viewed as a long-term strategic position rather than a short-term trading opportunity. For those portfolios that are willing to take on more risk, the allocation of Bitcoin can be higher. An advisor should also take into consideration which part of the existing portfolio the Bitcoin allocation will replace. In the portfolios I personally manage, I have built the allocation as part of the alternative assets sleeve, but some advisors prefer to fund it from other equity portions, particularly from the more aggressive growth allocations. Due to Bitcoin's potential for rapid price changes, its weighting within a portfolio can shift significantly. It's vital to regularly monitor and rebalance this position to maintain the desired asset allocation and risk profile. There's also a lack of intrinsic value and traditional metrics that are used by advisors. Unlike stocks, Bitcoin does not generate cash flow or pay dividends. Its valuation is primarily driven by supply and demand dynamics, investor sentiment, and adoption trends, making traditional fundamental analysis very challenging. Also, the global regulatory environment for cryptocurrencies is still developing. New regulations concerning taxation, trading, or even outright restrictions in some jurisdictions could significantly impact Bitcoin's value and liquidity. Now, on a positive note, there is a tremendous amount of institutional adoption in this space. The accumulation of spot Bitcoin ETFs has risen sharply, grossing over $15 billion. This increased liquidity and institutional participation have made Bitcoin a more relevant asset in diversified portfolios.